Let's talk to best-selling financial author and Barron's associate publisher, Jack Otter. You know, the flip side of trade wars is that they can boomerang. The president is convinced right now that won't happen. What do you think?
Well, can I say, before I answer that question, Neil, I hate to dodge it, but I do want to say that volatility always happens, and I don't want anyone to make their investment decisions based on whether they love or hate Trump, because your 401k doesn't care.
And your 401k goes through presidents of both parties.
Exactly.
Usually.
Exactly. So now that I got that out of the way, obviously a trade war is not a good thing for the markets, for savings, and so forth. Net, it's actually not a good thing for jobs. Certain industries will, of course, benefit, but the total number, we will lose more jobs than we will gain from a trade war. And in any event, the market doesn't like surprises. So the market will get spooked. It'll go up and down. And people just need to prepare for that and understand that the market always goes up and down. So the Barron's cover this weekend is going to be about cash. You know, it's yielding a little bit more. We're suggesting maybe people, put aside a little cash. And then if you're a long-term investor, great. If you like to trade, you might get an opportunity.
Why are you basing what is typically a conservative call now on the belief that the trade war is going to materialize?
That is certainly one. Two reasons. One, yes, we think there is danger of greater volatility. And number two, because you're actually getting something for cash now. Call it 2%. A 5-year CD is a little over 3%. There are other things, some floating rate funds that look interesting right now. So it ain't nothing. And it might be good to have some liquidity, because here's what you don't want to be. You don't want to be the person who's forced to sell when the market's down 30%. If anything, you want to be the guy who happily buys at a lower price from those people who are forced to sell.
Yeah, usually those forced to sell have margin requirements. They bought a lot of the stocks and run up on that. What do you make of the tax cut impact? Well, I've got you here.
Sure.
I always think that a lot of this started, you could argue, in anticipation of tax cuts, but they weren't looking like such a sure deal. But I think a lot of it started with the deregulation push. What do you think?
Well, I think it's a combination. Both of we should distinguish the corporate tax cut and the deregulation are obviously good for companies. We saw right on the balance sheet the earnings skyrocketed. Was it 15% because of the tax cut? Now that's going to level off. You're not going to get that every quarter. Now they're going to continue to go up by not by that much. That is definitely a help. Here's the interesting sort of conundrum, though. As that goes up, it pushes the Federal Reserve to start to worry about an overheating economy. And so if the interest rates go up enough, it's nice for your savings account, but at some point, then that starts to dampen the beneficial effects of tax cuts. And meanwhile, you've got this yawning deficit. So we have to play that carefully. The good news about tax cuts is if they can generate more economic activity, then you generate more taxes, and therefore the deficit shrinks. We're not on that trajectory right now, and that's a little bit worrisome.
I don't know anyone who worries about deficits, right? And they should. To your point, I think you're absolutely right.
But you're right.
It's not on anyone's radar.
Yeah, it's not. It will be soon, but for the moment, it certainly is not there.
The flip side of the higher cost of items that you get with the tariffs and all that, this is maybe perverted logic, but this notion that the Federal Reserve is less inclined to raise rates because it would slow the economy down.
Right. So that's the third element, right? So you've got tax cuts pushing the economy up. Then you've got the potential for interest rates putting the kibosh on it. But then you've got a slowing global economy from a trade war, which means maybe the Fed can sit back and not be as aggressive as people are expecting, which all of that points to volatile markets. So people should prepare for that, and you don't want to be freaked out if the market should fall 10%. I'm not saying it will, right, but it all is a contribution toward volatility. And as an investor, again, set aside politics, be the person who's ready for that rather than the person who's caught by surprise.
Cash in anyone's portfolio is not a bad idea.
Absolutely. When you suddenly need money, you want that money to be sitting there and not have to sell to get it, because it always happens.
Well, what percentage is Barron's recommending?
We don't.
You don't want to tip your hand, right?
We do. Well, no, it's not that. It's just that it really is. I know this sounds like a cop-out. It's totally different. If you are a 65-year-old retiring next year, you want you want 3 years worth of cash.
Right.
If you are a 38-year-old, have enough in case you lose your job, but otherwise you ought to be aggressively invested. In fact, we had a financial advisor tell us that in his retirement accounts for a 40-year-old, 97% equities.
Whoa.
Yeah.
Holy cow. All right. There's got to be a happy medium. I don't know what that is. Jack Otter, thank you very, very much. Barron's associate publisher.